Welcome to Breaking News to Trading Moves. Today we're focused on how a specific corporate update, even one that seems pretty routine, can really redefine priorities for an entire industry. We are going to look at the market reaction to the recent financial update from Moderna, that's ticker mRNA, which they gave at the J.P. Morgan Healthcare Conference.
It was a really good case study in investor psychology. When a company like Moderna announces news that, looks positive or at least stable on the surface and the stock goes down, well, that's the market sending a very clear message about what it's worried about right now.
Exactly. The tension there is obvious. Moderna announced positive sales tracking, they reinforced their long-term growth plan, and they detailed cost-cutting. All things that should build confidence. And yet the stock came under pressure.
It did.
So today, we'll explore why the market reacted that way. And more importantly, we're going to use this mRNA event as a reference point to identify three distinct categories of winners and three categories of losers across biotech, pharma, and even the retail pharmacy space.
We're basically using one piece of news to get a read on the risk appetite of the whole sector.
Okay, so let's start with the hard data, the facts that Moderna actually presented. This update was meant to outline their trajectory now that we're past the peak of the pandemic. They're trying to move from being an emergency supplier to a sustained commercial business.
And they gave very concrete numbers. They were clearly designed to suggest a stable outlook, focusing on both the immediate financials and the long-term plan.
That's right. For their 2025 revenue outlook, the guidance they gave pointed to about $1.9 billion. And the key thing is, this number was above the midpoint of the guidance they had shared before. For any company, raising your midpoint is usually a good sign. It suggests you're executing well.
Right, and they projected that stability forward, too. They specifically reiterated a plan for up to 10% revenue growth in 2026. So this wasn't just a static forecast. It was management committing to growing a sustained revenue base, which is exactly the reassurance you'd think the market wants to hear.
And beyond revenue, they did address the cost side. That's probably the most scrutinized part of their business, given how fast they scaled up. They guided their 2026 non-adjusted operating expenses to about $4.9 billion. Now, if you compare that to their estimate for 2025, which was in the range of $5 to $5.2 billion, you can see a deliberate cost control plan. It's a reduction of somewhere between $100 and $300 million year over year.
And that expense reduction is supposed to send a message. It's management saying, we know we need to be efficient and we're bringing spending in line with the new reality. It's capital discipline in action, or at least the promise of it.
They also talked about pipeline progress, which is vital for them to diversify away from just the COVID vaccine. They confirmed the company has filed for approval of its standalone seasonal flu vaccine, that's mRNA 1010, in multiple countries. And they said approvals could start coming in 2026, which shows they're moving forward.
So if you just list out those points, the raised revenue outlook, the reaffirmed growth, the cost reduction plan, and the pipeline progress, well, they all point to operational stability and a clear path forward. But as you said, the stock, mRNA, fell right after. And that's the puzzle we have to look at.
This is where we have to get past the raw numbers and into investor psychology, because that's what really drives stock movement, especially for these high-growth platform-based biotechs. We often call this the trust and timeline story for Moderna.
That phrasing is perfect. The market's focus right now isn't so much on the reaffirmed numbers for the next year or two. It's really about proving the long-term sustainable structure of the entire business. I mean, Moderna had one of the fastest scale-ups in corporate history, built on a single revenue stream. Now investors are demanding proof, clear, undeniable proof that the company can turn all that capacity and technology into a reliable, diversified, and profitable business that doesn't need a global emergency to thrive.
So it's not just about, can you deliver a new flu shot? It's more about, can the massive infrastructure you built for COVID pivot and sustain itself efficiently in a normal, competitive market?
Absolutely. And the timeline part of that refers directly to how long it's going to take for the company to grow its non-COVID revenue enough to cover the immense R&D and operational costs. And that's what it takes to maintain a platform biotech like mRNA.
Which brings us to the core pressure point, the path to cash break-even. That's where investors were looking, and they were questioning whether the spending cuts were aggressive enough.
Precisely. Investors looked at that $4.9 billion expense target for 2026, and they immediately asked if that spending needed to be cut even faster. When a company is valued so heavily on its future potential, what we call a high multiple valuation, any delay in getting to break even gets punished, and it gets punished disproportionately.
I want to focus on that high multiple valuation idea for a second. Why is mRNA so sensitive to a delayed break-even compared to, say, a company like Merck, MRK?
It's the difference between being priced on cash you're making today versus cash you might make in the future. A company like Merck, MRK, is valued heavily on the cash it generates right now from blockbuster drugs already on the market. Its valuation is backed by tangible, established profits.
Right. It has a fortress of existing revenue.
Exactly. Moderna, mRNA, on the other hand, isn't just priced on that $1.9 billion they expect in 2025. It's priced on the expectation that its technology platform, its personalized cancer vaccines, its RSV shot, its flu shot, will change medicine over the next 5 or 10 years. Investors are paying a premium today for that future. So if the timeline to get to that future gets longer, or the costs to get there are higher than you thought, the value of those future earnings drops.
So when the market sees a $4.9 billion operating expense forecast, it's saying, we hear you on the $100 million cut, but to justify your current valuation, we need you to get to a cash-positive state faster.
That is the exact tension. The market is demanding faster proof that the non-COVID growth can actually justify the spending needed to maintain the platform. Any sign that growth might be constrained or that cost reductions are too slow, it introduces uncertainty. And when you apply that uncertainty to a highly priced growth stock, the pressure is immediate. It's a very clear signal that risk tolerance is declining across the whole biotech sector. The reaction to Moderna, mRNA, really provides the clearest evidence of the main theme in the capital markets right now. And that is the absolute priority of capital discipline. I mean, the efficient, effective use of every single dollar.
And this is a very different sentiment from just a few years ago. During the pandemic and that whole easy money era, the focus was all on speed, innovation, and just scaling the business at any cost.
That's right. We've moved from an environment that was all about aspirational growth and the excitement of new technology to one that is all about rigorous execution, distribution capabilities, and disciplined pricing. The market isn't just content to bankroll the dream anymore. It's demanding that all that spending leads to sustainable, verifiable cash flows.
So the whole investment calculation has flipped. For this part of the market, the question isn't how big can you be someday anymore. It's how efficiently are you operating right now, and what's your real timeline to profitability?
That is the absolute definition of the current mandate. Investors want visible, measurable progress toward being profitable. For a lot of these high multiple biotech companies, capital discipline, your cash runway, your quarterly burn rate, your timeline to break even has become more important than the promise of a huge pipeline.
And when a high-profile company like Moderna, which has huge scale and a proven product, gets this kind of pushback, even after showing some expense control, well, that serves as a powerful barometer for the whole sector. It basically sets the standard for financial rigor for everyone else.
It's a caution flag for the whole industry. It tells every CEO and CFO out there that investors are way less willing to fund potential and are intensely focused on proved efficient returns. This tightens the availability of capital for riskier ventures. The mRNA news wasn't just about one company's guidance. It confirmed a broader trend toward fiscal conservatism in healthcare investing.
Right, and understanding this focus on capital discipline is the critical framework. It's what allows us to separate the companies that are insulated from this kind of scrutiny, the winners, from those whose reliance on future funding makes them vulnerable, the losers. Okay, so based on this new market mandate for capital discipline and improved efficiency, we can identify 3 distinct categories of companies that are poised to benefit. Let's start with category 1, the large-cap pharma companies with vaccine scale and existing respiratory franchises.
The rationale here is really all about market maturity. The Moderna update reinforced what we've been seeing. The respiratory vaccine market, so flu, COVID, RSV, is no longer in an emergency high-margin state. It's settling into a normal commercial cycle, and that's defined by seasonal demand and the huge logistical challenges of managing a portfolio of products.
And when a market matures and stabilizes, the scale and the established cash flow of big pharma become huge competitive advantages.
Precisely. Companies with massive, diversified platforms and existing strong cash flows are just better positioned when the focus moves from early-stage promise to disciplined execution. They have the financial resilience to manage the lower margins and the increased competition that come with a mature market.
So what specific attributes define these companies as winners in this environment?
The first, and maybe the most important, is their established distribution network. I mean, getting seasonal vaccines to millions of pharmacies, clinics, hospitals, and governments all over the world in a tight time window requires an enormous logistical footprint. Smaller biotechs just can't replicate that kind of entrenched infrastructure.
And then there's the whole issue of pricing discipline in a much more competitive arena.
Right. In a mature market, you sustain profitability through your expertise in negotiating with payers. Large pharma has the experience and, crucially, the portfolio leverage. They can bundle and negotiate for multiple blockbuster drugs at once to sustain their pricing structures and absorb pressure better than single-product companies.
And the long-term plan is for combination products.
The future is combining multiple targets like flu and COVID or RSV into one shot. That takes gigantic R&D resources, complex clinical trials, and deep regulatory expertise. These are core competencies that only the largest pharmaceutical companies can really deploy at scale.
Okay, let's look at the names in this category, starting with Merck & Co., ticker MRK.
Merck, MRK, is the epitome of stability through diversification. Their cash flow is built on established, blockbuster oncology products, and that creates a financial moat that insulates their research efforts. This foundation allows them to invest in the vaccine segment without the same pressure mRNA faces to generate immediate revenue just to keep the lights on. Their ability to generate consistent free cash flow makes them a winner in a market that's obsessed with capital discipline.
Moving on to Pfizer, ticker PFE. Pfizer has obviously cemented its position in the respiratory market and has all the necessary infrastructure.
The scale of Pfizer, PFE, is just hard to rival. This means they can manage the natural ups and downs in seasonal demand without it putting a strain on their financials. They have decades of history managing high-volume manufacturing and complex global logistics. That gives them a competitive advantage when smaller competitors are struggling with things like inventory management and high distribution costs.
And rounding out this category is GSK PSC, ticker GSSK.
GSK, that's GSK, has one of the longest and deepest histories in the vaccine space. They've had success with their RSV product rollout, for example. They are equipped with the scale and the expertise to navigate the lower-margin, higher-volume world of a stabilized respiratory vaccine market. They are structurally set up to handle the pricing and logistical demands that are now straining their less diversified peers.
Our second category of winners are the suppliers, the pick-and-shovel providers in bioprocessing and life science tools. And the rationale here is a direct consequence of Moderna's stated goal to cut costs.
This is a classic supply chain dynamic. When drug and vaccine developers, including mRNA with its $4.9 billion OPEX target, prioritize cost control, their internal focus shifts. It shifts to optimizing supply chains and standardizing production to drive down the unit cost of every vial.
The counterintuitive point here is that you might think expense cuts mean buying less equipment, which would hurt suppliers. But that's not always how it works. Why does the efficiency mandate often translate into sustained demand for these tool providers?
Because real efficiency doesn't mean stopping production. It means eliminating variability, reducing waste, and upgrading to higher throughput, more automated systems. Cost optimization requires technology investment. It still requires massive volumes of consumables, specialized hardware like bioreactors, and very robust quality control workflows that are mandated by regulators.
So these tool providers offer solutions that let drug developers scale production up while driving the unit costs down. They essentially win regardless of which specific drug developer ends up with the next blockbuster.
That's the core of the pick-and-shovel strategy. Their business success is diversified across the entire biopharma manufacturing base. As long as late-stage pipelines keep advancing across the industry, which they are, independent of Moderna's stock price, the demand for the tools and media needed to manufacture those drugs remains stable. This makes them much less susceptible to the kind of single-asset volatility that hit mRNA.
Let's look at the giants here, starting with Thermo Fisher Scientific, ticker TMO.
Thermo Fisher, TMO, is the benchmark for stability in this sector. They provide everything from sophisticated analytical instruments for quality control to high-volume manufacturing consumables like cell culture media and single-use systems. As companies like mRNA try to reduce cost variability, they rely on integrated suppliers like TMO for reliable, standardized products. TMO is a beneficiary of the industry's new focus on being thrifty.
Next, we have Danaher, ticker DHR. Danaher has positioned itself through acquisitions in critical bioprocessing and diagnostic areas.
Danaher, DHR, benefits a lot from the regulatory environment. The quality control aspects of manufacturing, whether it's a gene therapy or an mRNA vaccine, are non-negotiable. Even when general costs are being cut, regulatory compliance and product quality have to be maintained. This drives sustained demand for DHR's specialized tools and consumables used in purification and quality testing. They're selling necessities.
And finally, Avantor, ticker AVTR.
Avantor, AVTR, is deeply embedded in the supply chain for biopharma manufacturing. They specialize in high-purity materials, solvents, and custom chemical solutions. As large pharma and biotech players try to streamline their procurement to meet those demanding expense reductions, Avantor's role as a trusted supplier of standardized, high-quality inputs becomes even more valuable. They help manufacturers reduce risk and complexity in their own supply chains, which directly contributes to capital discipline.
Our final winner category is tied to the long-term optimism around the mRNA platform itself, focusing on immuno-oncology leaders. And this links directly back to the pipeline updates Moderna gave.
Right. Moderna specifically highlighted that they have upcoming clinical readouts scheduled for 2026, centering on their personalized cancer vaccine work. This is a critical collaboration with Merck, MRK, and it represents a huge future opportunity for the mRNA technology platform.
Why does positive data in personalized cancer vaccines provide a lift to the entire oncology sector, even for companies not directly involved?
Because it provides powerful validation for the underlying mRNA platform technology when it's applied to complex, non-infectious diseases. Cancer vaccines are really on the cutting edge of personalized medicine. Successful clinical results here send a signal that the core technology is robust, reliable, and can be applied across different types of therapies, not just for infectious diseases.
So it doesn't just help mRNA, it de-risks the whole class of advanced combination therapies.
Precisely. If that personalized cancer vaccine data proves to be constructive, if it shows strong efficacy in combination with existing treatments, it immediately boosts investor sentiment across the whole immuno-oncology field. It suggests that these novel approaches to stimulating a patient's immune system against their own tumors are scientifically and commercially viable, and that benefits the established companies that already have foundational assets in this space.
Okay, let's review the names poised to gain from this, starting with Bristol Myers Squibb, ticker BMY.
BMY is a recognized leader in immuno-oncology treatments, especially with their checkpoint inhibitors. If the personalized cancer vaccine space gains real clinical momentum, BMY is exceptionally well positioned. They could integrate these new approaches into their existing treatments, probably through future partnerships. Success for the mRNA-MRK collaboration validates the whole approach of combining vaccines with existing immunotherapies.
Next, we have Regeneron Pharmaceuticals, ticker REGN.
Regeneron, REGN, is highly regarded for its innovative R&D. They have a strong, diversified pipeline in immunology and oncology. They're seen by the market as a high-quality innovator. So positive data that validates a complex, novel platform like personalized vaccines lends immediate credence to other high-science, pipeline-driven strategies. It's a general lift in confidence for companies like REGN.
And Merck & Co., MRK, shows up here again. That underscores its dual role as both a stable fortress and a pipeline leader.
Exactly. Merck, MRK, is included here because they are the direct and critical partner in Moderna's personalized cancer vaccine work. Any clinical success is their success. It validates their own strategic commitment to the space. Plus, their position as the leading immuno-oncology player means they are poised to benefit if the combination therapy approach. So, the vaccine plus their established treatment proves successful. They're a direct beneficiary of the data and an indirect beneficiary of the market optimism. So now we have to turn our attention to the other side of this. The new market mandate for capital discipline creates real headwinds for specific parts of the biotech and healthcare market. We've identified 3 categories facing intense pressure because of high burn rates, structural volatility, or their reliance on high-volume traffic.
Well, let's start with the group most directly exposed to the funding climate. Category 1, the cash burn and funding-sensitive biotech companies. The market's reaction to Moderna, mRNA, company with a product and billions in revenue, serves as a clear signal that the investment community is prioritizing immediate discipline over long-term aspirations.
And this tightening of risk appetite has an immediate and disproportionate impact on companies that are structurally dependent on raising money in the near future. Companies that lack clear near-term revenue. These are the ones with high cash burn rates, where their spending far outstrips any income and their operational runway is finite without new financing.
How much harder does this market make it for them to get that financing?
It creates a severe and immediate valuation challenge. When investors are fixated on an immediate path to break even, high burn, pre-commercial companies get penalized intensely. Investors are less willing to fund long research stages. They're demanding faster, more clearly defined clinical milestones and responsible expense management. A small clinical setback, or even just a longer regulatory timeline, can drastically reduce their ability to get favorable financing.
Let's review the names whose high burn rates make them vulnerable here, starting with Sana Biotechnology, ticker SANA.
Sana, SANA, operates in highly complex areas, particularly gene and cell therapy. These fields are inherently capital intensive. The clinical trials are complex, the manufacturing is bespoke and expensive, and the regulatory path is long. So, in this climate of reduced risk, the market looks at their reliance on future large scale funding rounds with a lot of skepticism until their clinical milestones translate into late stage commercial readiness. Their cash runway becomes the primary point of investor anxiety.
Next, Vir Biotechnology, ticker VIR.
Vir, VIR, is a perfect example of a company that needs to prove its sustainable model post-pandemic. They were heavily involved in the COVID response, but now they face the immense challenge of transitioning to a viable, diversified business model focused on other infectious diseases. They have to demonstrate highly effective capital deployment to generate entirely new revenue streams, and the market's reduced appetite for the vaccine pure play model creates headwinds when they try to raise capital. They're battling a tough market and a difficult transition story.
And finally, Beam Therapeutics, ticker BEAM.
Beam, BEAM, is focused on a revolutionary but incredibly high-cost and long-dated technology called base editing, a very precise form of gene correction. And while the technology holds great promise, the capital required to advance these sophisticated platforms through multi-year clinical trials is enormous. Because of the long duration and complexity of their approach, they are highly sensitive to market tightening. Their extremely high cash burn rate makes them very vulnerable when the mRNA news signals that the funding environment is becoming less tolerant of long-term potential without verifiable near-term efficiency. Our next category reflects the reality of market normalization. Category 2, COVID-era vaccine pure plays and smaller developers. Moderna's revenue trajectory, which is now far below its pandemic peaks, clearly highlights the extreme competitiveness of the current vaccine landscape. The days of guaranteed high-margin government contracts are over.
Which means companies whose business models were built around that emergency era are now facing a real challenge to prove their viability in a mature, competitive, and cyclical market.
That's precisely the situation. Smaller players in this space are exposed to multiple volatility factors at once. They lack the scale to manage the big inventory cycles driven by seasonal demand. They get crushed by pricing pressure from larger competitors, and they struggle with the complex channel dynamics in the global market.
They just don't have the diversified cash flows or the established manufacturing relationships that a Pfizer or a Merck does to absorb these fluctuations.
Their margin for error is minimal. Any dip in seasonal uptake or a successful launch from a bigger rival can disproportionately affect their financial outlook and threaten their ability to remain a viable entity. The mRNA update confirmed that the large players are focused on efficiency, which just makes life harder for the smaller players who can't match that scale.
Let's look at the companies struggling with this transition, starting with Novavax, ticker NVAX.
Novavax, NVAX, despite having a differentiated protein-based vaccine technology, has faced chronic commercial, manufacturing, and regulatory hurdles in turning that technology into steady revenue. Their singular reliance on vaccine sales means they are directly and completely exposed to the competitive pressures that were underscored by the mRNA update. The market is demanding efficiency and commercial success, which NVAX has struggled to deliver consistently.
And Ocugen, ticker OCGN.
Ocugen, OCGN, is a smaller developer whose fortunes are heavily reliant on the success of specific development partnerships and commercial rollouts. Their exposure to the volatility and shifting demands of the global vaccine market is amplified because of their smaller scale. When the market sees even mRNA struggling to meet demanding investor expectations for cost and efficiency, it immediately compounds the perceived risk for smaller, less established vaccine players like OCGN.
Our last category shows how a single biotech news event can have commercial reverberations in adjacent sectors. Why are retail pharmacy chains, category 3, exposed to softer vaccination traffic, even if Moderna's revenue trends were less bad than feared?
This is a crucial area of commercial sensitivity. While mRNA's revenue trends weren't the worst-case scenario some feared, the overall data reinforces the fact that U.S. retail vaccination volumes across all respiratory vaccines have been under pressure compared to the last couple of years.
So we're not just talking about a slight drop, we're talking about a quantifiable reduction in patient flow through the pharmacy doors for these services.
Exactly. And the financial exposure for major retail pharmacy operators goes way beyond just the service fee they earn from giving the shot. The real economic driver is the front-of-store economics. A vaccination appointment acts as a primary traffic driver, bringing consumers physically into the store who might otherwise shop online.
And once they're in the store, they make impulse purchases.
Absolutely. When a consumer comes in for a scheduled vaccine, they often buy over-the-counter medications, health items, or general merchandise while they're waiting. These are typically higher margin sales. The vaccination service acts in effect as a traffic generator that boosts the general retail sales segment of the pharmacy's income.
So fewer vaccination services mean reduced service appointments and, more importantly, less foot traffic to generate those critical retail sales.
That is the direct exposure. If respiratory season traffic doesn't see the strong rebound that management teams had hoped for, and mRNA's return to normalization reinforces that view, the reduced vaccination volumes negatively impact both those front-of-store economics and the company's ability to meet expectations for service margins.
Let's look at the two major players here, starting with CVS Health, ticker CVS.
CVS is a vast integrated healthcare provider, but its core retail pharmacy segment is still highly reliant on service activities like vaccinations to drive essential traffic and ensure efficient use of its pharmacy staff. A sustained industry-wide trend of softer vaccination traffic puts quantifiable pressure on the retail division's margin projections and their ability to leverage those front-of-store sales.
And Walgreens Boots Alliance, ticker WBA.
Walgreens, WBA, is facing parallel pressures, maybe even more acutely because of their ongoing aggressive cost management initiatives. The success of their whole retail strategy is tied closely to maximizing service offerings. If a major seasonal traffic driver like vaccinations underperforms, it weighs negatively on the company's ability to meet its broader fiscal goals for a retail turnaround. The mRNA announcement, by reinforcing the normalization of vaccine demand, serves as a clear data point confirming the challenging conditions these pharmacy chains are navigating.
We have completed our analysis of the market's reaction to Moderna mRNA and what that reaction represents. The overall undeniable takeaway is that the mRNA update provided a clear line in the sand. The era of speculative growth and open spending in biotech is evolving into one demanding verified execution and rigorous cost control.
The market is now assessing companies not just on the potential of their pipelines, but on their tangible ability to manage expenses, achieve efficiency, and deliver on those pipelines while moving toward cash break-even. It's a defining focus on fiscal sustainability and operational excellence.
We saw clearly how that singular focus elevates large, diversified pharma companies, those with cash fortresses, and the stable life science tool providers who enable efficiency, while at the same time creating friction and risk for highly capitalized but pre-revenue biotechs and even adjacent retail businesses.
And this transition raises a compelling question for you, the listener, to consider. We've looked at respiratory vaccines, drug manufacturing, and retail services, but this mandate for capital efficiency is unlikely to stop here. Where will the next area of intense capital scrutiny emerge as the market continues its focus on fiscal sustainability? Will it be high-cost areas like specialized diagnostics manufacturing, or maybe outsourced clinical trial organizations? Investors are now looking for efficiency and cost reduction everywhere, and that search will undoubtedly expand.
A compelling thought to mull over as you navigate these complex markets. Please remember that the content of this program is purely the opinion of the author and should not be construed as financial advice or as a recommendation to buy or sell any security.